All right, welcome to The Explainer. Today we're looking at a commodity that's making a pretty unlikely comeback. And it's being driven by a force that you might not expect, the absolutely explosive growth on artificial intelligence.
The answer really comes down to one word: power. I'm talking about a colossal and unrelenting need for electricity that is sparking a surprising energy crisis and totally reshaping global markets for this unassuming element.
You see, it all starts with this massive, kind of hidden thirst for power that AI requires. I mean, think about it. The computations behind every single chatbot query, every image you generate, they consume an incredible amount of energy.
And the sheer scale of this it's hard to wrap your head around. Projections are showing that data center consumption is going to nearly double to 945 terawatt hours. Now, to put that in perspective for you, that's a growth rate 4 times faster than the growth in total global electricity demand. It's just a staggering pace.
So, to meet this incredible demand, the biggest names in tech, they're turning to the one source that can deliver massive amounts of clean, reliable, around-the-clock power: nuclear energy. They're literally signing deals directly with nuclear power providers because, frankly, it's the only proven way to power their enormous data centers without any interruption and without carbon emissions.
But here's the kicker. Just as this new wave of demand for uranium explodes, the supply side is facing a historic crunch. It's really creating a perfect storm in the market.
And here's the core of that supply problem. A huge portion of the world's uranium, I'm talking 43% of it, comes from just one country, Kazakhstan. Now, whenever you have so much supply concentrated in one place, any little disruption creates these huge ripples across the entire market.
And this isn't just some temporary hiccup. We are seeing the world's single largest producer facing serious structural problems, like a shortage of the sulfuric acid they need to even extract the uranium. They're already forecasting a 10% production cut. And believe me, when the biggest player stumbles, the entire market feels it.
And as if that wasn't enough, on top of those production issues, geopolitics is just strangling the supply chain. You have the U.S. ban on Russian uranium, which was then followed by Russia's own export restrictions, and that has forced this massive global realignment. Western countries are now in a desperate scramble to find new, secure, and, friendly suppliers.
So, okay, demand is soaring, supply is tightening. Who are the key players in this high-stakes market? Let's break down who's who.
You can really think of the market in 3 main tiers. First, you've got the major producers, like Cameco, right? The giants who are actively mining and selling uranium today. Second are the developers, companies like NextGen, who are exploring and building the mines of tomorrow. And then finally, you have these physical trusts, which they don't mine at all. They simply buy and hold physical uranium, and they impact the market in a really unique way.
Now, one of these players has a really unique and powerful role: the Sprott Physical Uranium Trust, or SPUT as it's known. It kind of acts like a strategic reserve for investors. It just buys up physical pounds of uranium and locks it away, which effectively removes it from the market that utilities need to buy from.
And their buying has been incredibly aggressive. I mean, in 2025 alone, they've already added millions of pounds to their holdings. Every single pound they buy is one less pound available for a nuclear power plant. A plant that might be powering the next generation of AI. And that, of course, puts constant upward pressure on prices.
Okay, this is where things get really interesting. Now we get to the core insight of this whole explainer. In investing, simple labels like safe country or risky country, they can be dangerously misleading. We're going to break down this myth of jurisdictional risk.
So, on the surface, the choice for an investor seems pretty obvious, right? You invest in a safe country like Canada, which gets a huge valuation premium, and you avoid a so-called risky one like Niger. But what if that's the wrong way to look at it? What if the real risk isn't the flag, but the follow-through?
And this brings us to a really critical correction. The argument is that the real risk in a place like Niger isn't about some general political instability. No, it's about a company's specific actions. It all comes down to whether they're actually complying with local mining laws and actively developing their projects.
And you can see this in action right here. Just take a look at the companies that actually lost their permits. They had held them for over a decade without even starting to mine. So Niger simply enforced its use it or lose it laws. This wasn't some random seizure. This was regulatory enforcement. And at the same time, a company like Global Atomic, which is hitting its development targets, hiring locally, well, they have explicit government support and are operating without any issue.
So what does this all mean for actually understanding the market?
To figure that out, let's do what they always say and look at what the big institutional investors, the smart money, are actually doing with their cash.
And when you follow the money, a really clear pattern just jumps right out at you. Capital is flowing into companies that are already producing uranium and generating cash, like energy fuels. And at the exact same time, it's flowing out of companies that are still in that development or restart phase. Companies like Paladin, Deep Yellow, and even Global Atomic.
So this shows us the market isn't selling a company because it's in Niger or Namibia. It's selling companies that aren't yet producing cash. Investors are prioritizing immediate returns over future potential. That's a classic risk-off move that has everything to do with when a mine will make money, not where it's located.
So this suggests a much smarter, more sophisticated way to look at the market. You could anchor a portfolio with stable producers, add some of those high-growth developers in the so-called safe locations, and then, and this is the key, look for those compliant, high-quality developers in emerging regions that the market might be unfairly punishing. That's where the real value might be high.
Ultimately, this whole situation forces us to ask a pretty fundamental question. When the entire landscape of energy and technology is being redrawn by forces like AI, is the biggest risk you can take simply relying on the old, simple rules? Maybe the time has come to look for a more nuanced map.